Welcome back to Factful Finance. Today we're diving into one of the most critical events in financial history, the 2008 financial crisis. But instead of the usual blame game, let's focus on a key player: financial derivatives. How did these complex financial instruments contribute to the disaster that shook global economies? Buckle up, because you're about to uncover the hidden mechanisms behind one of the most explosive financial crashes in modern history. Now you might be thinking, what are financial derivatives, and why should I care? Great question. A financial derivative is a contract whose value depends on the price of something else, like stocks, bonds, commodities, or even interest rates. It sounds abstract, but derivatives are tied to real assets, and they can be used for hedging risk or, as we'll see today, for reckless speculation. In the lead up to 2008, derivatives were wildly popular, especially a type called mortgage-backed securities, MBS. These are bundles of home loans that were repackaged and sold to investors. In theory, MBS were a great way to spread risk. But here's where things went wrong. These securities were often bundled with risky subprime mortgages, loans given to people with poor credit. The idea was that the returns from these loans would be high enough to make them appealing. But with more people defaulting on their mortgages, the value of MBS plummeted. But it didn't stop there. Enter credit default swaps, CDS, another type of derivative. These are like insurance policies on the MBS. If an MBS defaulted, the CDS buyer would get paid. Financial institutions and hedge funds were using these swaps to bet on the continued success of these mortgage securities. They didn't just want to protect their investments, they were speculating, taking huge, leveraged positions to profit from the risky bets. As long as housing prices kept rising, everything seemed fine. But once prices began to fall and defaults surged, the value of MBS and the CDS contracts tied to them collapsed. Banks that had heavily invested in these derivatives, like Lehman Brothers, found themselves unable to cover their massive losses. The ripple effects were felt worldwide. In fact, the global economy nearly spiraled into complete chaos. To make sense of this, let's zoom in on a real-world scenario. Think about Liam, an investor who buys a CDS on a mortgage-backed security, believing the housing market will continue to grow. He's essentially betting that the MBS won't fail. But as housing prices begin to plummet, more people default on their loans, causing the value of the MBS to fall, and Liam's CDS is suddenly worthless. Banks that held these securities are exposed to billions in losses, sparking a chain reaction that pulls the entire financial system down. By 2008, financial derivatives, once seen as a clever tool for risk management, had become ticking time bombs. The risks were so opaque and so widespread that even experts couldn't predict the full scale of the disaster. The collapse wasn't just about bad loans. It was about the unchecked, irresponsible use of financial derivatives that magnified the crisis. But here's the big lesson. Derivatives, when used properly, can help businesses manage risk. However, when they're misused, when they're used to gamble on the future without a clear understanding of the risks involved, they can create a financial house of cards. And in 2008, that's exactly what happened. This brings us to a crucial takeaway. Managing risk is at the heart of sound financial practices. Understanding financial products, especially derivatives, is crucial for anyone looking to navigate the financial markets wisely. Whether you're investing, building a business, or planning for retirement, understanding the risks and rewards of complex financial instruments can make all the difference. Remember, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Want to dive deeper into how these financial instruments can affect your investments today? Drop your thoughts or questions in the comments. I'm here to respond to as many as I can. If you found this breakdown helpful, wait until you see what's coming next. Keep watching for more insights that can help you level up your financial game.